NDA has taken a lead as expected in early counting, but the numbers may very well change as we await more rounds of EVM counting. Joining us now to talk about all of this is Nilesh Shah of Kotak AMC and Sanjay Dutt of Quantum Securities. Gentlemen, good morning and thanks so much for taking the time out. Nilesh, with an assumption that what the tallies are showing right now, what do you think is next in course for the markets? Because right now, the equity markets seem to have given their verdict, 200 points up on the Nifty.
I think, Neeraj, market has been giving that verdict since last Thursday, where it started moving up. Then on Sunday, exit polls came and Monday market made one move. And today's early indication also gives confidence to the market. So somewhere market is pricing in a stable government, but more importantly, market is now pricing in that there will be decisive action by the new government to shore up the economy from current level, that the earnings growth will revive in corporate India, and that revival of earnings growth through various measures will support the market going forward.
So, Nilesh, the continuity would mean that there could be some benefits of the earlier stated reforms, GST for example, which might start coming in as well. Mike, the question is, from a market's perspective, does the new government, whichever the government is, need to do something drastic in the first 6 months, or just plain Jane continuity would take care of most things?
No, there is a need to take certain actions by the new government. For example, we had persistent high inflation few years back, and then RBI government worked together and God favored us through lower food inflation and oil prices. But we have now brought down inflation to much manageable level, more comparable to developed world. Now the gains on inflation has come in, and hence it is time to focus on growth, which means we have to provide adequate liquidity to the economy, which means we can lower interest rates from going forward, which means we can do better transmission of credit. We had high fiscal deficit some years back. Now we have chosen path of fiscal prudence. Fiscal consolidation is done, and there is room for more to do in order to ensure that real interest rates can come down in economy. So we have to focus on strategic divestment of government assets, monetization of government resources, so that there is adequate resources for investment in infrastructure, and at the same time the path of fiscal prudence is not forgotten. The other thing which we have to do is to support Make in India, or to encourage manufacturing in India. Over last few years, our trade deficit with China has gone up substantially. Of course, there are some items which we have to import from China, but there are few items which we can afford not to import from China, which will encourage local manufacturing. How do we continue to improve ease of doing business? How do we encourage businessmen to go for productivity and scale? How the infrastructure built in terms of road and railway over last 5 years can support Make in India. What we have done in telecom sector, where from 2 factories before 2014 to 120 factories today, including the world's largest mobile handset plant at Noida by Samsung, how do we replicate that in other sector? So there is a chart or a path for the new government to take on based on the gains or foundation laid out in the previous year, so that our economic growth moves into double digit rather than into around 7%.
Sanjay, coming on the early exuberance in the market, we've seen the initial leads and clearly in replicating what the exit poll suggested, but still too early to say. But now that we are at record highs of somewhere closer to 12,000 already, is it going to be a slightly more tough ask to get an incremental move from here?
You know, I think what we're going to see now is a disconnect between the index and what the rest of the market does, because the rally would be much more widespread. This event is out of the way, And what Nilesh correctly said, that if government takes on these measures aggressively and much faster pace than what government has been doing in the last few years, then I would see the rally spreading out. So to cut a long story short, the index may not show huge gains, but I think the gains that you will get in stocks, good quality A and B group stocks, which have underperformed for various reasons, some local to those particular industry or stocks, some structural to the overall issues that we're dealing with, like Nilesh pointed out, cost of funds, ease of liquidity, etc. That rally will, I think, spread now. Right now, it's just concentrated to the 7 or 10 stocks which have taken the Nifty up. So Nifty may not show substantial gains going ahead in the short term, but I think the rally should spread now.
So, while we've been talking about what the government could do in terms of policy continuity and the others, fixed capex growth ahead of the budget decelerated. There were some budgetary constraints. Investments were pushed back because of the election constraints. Do you expect all of that to come back in a big way?
I think the single most important thing which the government, I'm sure, will do now is going to get very aggressive on enforcing GST discipline, compliance. Because today, even after GST implementation, there are leakages in the system. I would say comfortably 30 to 40% the system is non-compliant. So government is going to aggressively crack down on those. Government was going a little soft because elections were around the corner. So I see a substantial jump in the GST collections going ahead from the average 1,10,000 crores we saw in the last 2-3 months. I think we will see a substantial bump up in that. Those leakages will start being clamped down. In addition to that, I see some very aggressive measures to ease out bringing in capital into the country, meaning ease of business in terms of investors, both individual, institutional, as well as FDI investors coming into India. Those few measures, I think, are going to be very important to actually kickstart the private capex cycle. Of course, the budgetary issues of the GST end. So a combination of these two, three things I see happening in the next 3-4 months.
Okay. Nilesh, with an assumption that there is some bit of measures taken, and let's assume that the Reserve Bank also plays ball, in light of what the market wants, do you reckon that the risk reward is in a favor of a long-term investor right now to put in fresh, large money to work, or it would play to have some caution, wait for some action to be taken, and then see the reaction and then put money to work?
So it's always difficult to time the market, and hence we recommend people to do their asset allocation. As Sanjay mentioned, this is a market where we could now probably see widespread rally. So there is opportunity in certain pockets. If you follow the momentum and invest in few stocks which have moved up, way up in evaluation, then your either holding period has to increase tremendously or your expected return has to come down. But if you are willing to take risk and go to the bottom of the market and pick up stocks which haven't moved, where valuations are reasonable, then probably you could see market outperformance in that space. So it will essentially depend upon your time horizon, your expected rate of return, and your risk appetite.
Sanjay, the other part obviously has been in focus, that's been the liquidity constraint within the entire system, the NBFC issues that have been plaguing growth as a whole and disbursements as a whole. With relation to that, the RBI takes center stage now as to how it does, the OMO operations, what kind of policy measures it takes. It's already taken a 50 basis point cut. Is there a likelihood, because we have the policy just around the corner, is there a possibility of there being another cut, or this seems to be a little bit misplaced considering that the short-term rate since April of the 3-month T-bills is already up 20 basis points?
I think there would be a nominal rate cut somewhere around 25 basis points, but more than the rate cut, measures to deal with liquidity. And I think the ball is not totally in RBI's court. In fact, RBI, along with the government, machinery, that's the finance ministry and other government departments have to sit down and come out with a comprehensive solution that we're dealing with this animal called NBFC. We've had crisis upon crisis hitting us. We've had problems there. They need to come out with a comprehensive solution as to how are they going to deal with the NBFC liquidity requirements. What kind of NBFCs are going to be working, not working? What kind of NBFCs are going to grow big, which are going to be systematically important? Particularly after the ILFS incident, they need to tread very cautiously and have a clear policy with risk measures in place. So once you have, these two parallel systems, because see, we cannot do without the NBFC mechanism in the economy. We can't totally depend on the banking system, and we can't get rid of the NBFC system. So these measures, combination of these measures with RBI and the government policymakers, I think would deal with them. These were probably delayed because elections were there. Then of course, like you had the RBI circular, that also deals with a lot of other issues relating to some of the assets that were stuck with the February 12th circular. So now all these things will start moving, and as these things start moving and getting resolved, we will definitely see liquidity and a lot of other issues, structural issues being sorted out. So more than interest rates I think dealing with that 50 to 75,000 crores liquidity deficit, in my opinion, at this point of time, in my estimates, is what needs to be dealt with on a war footing over the next 2 to 3 weeks or as early as possible. And once that's dealt with, you will then see, industry starting to get funds at cheaper rates, liquidity being available to not only the larger companies, but also to the heart of the economy, that's the MSME and those people. This is, I think, key area which the government needs to strike immediately without delay. And of course, a little longer period, deal with issues of why we cannot have foreign capital be permitted to select NBFCs who have a relevant net worth, etc., and also foreign capital not available to other sectors. We need to make some major structural changes over the next 6 months, which I think will happen now because they've got a clear mandate as we see the election trends, and economy will start to pick up. And what Nilesh correctly said, that we need to see the revival of growth coming in, which will come in with these measures in the short term, and of course a lot of other structural measures.
Okay. Nilesh, then my final question to you. Year-end targets at the start of the year were pegged somewhere closer to 12,000. We're not yet halfway through the year. We're already about there. Does the target for the index change meaningfully?
It's always difficult to estimate year-end numbers. We have to live every day. An equity investment is not about 1 year horizon, it is about 5 and 10 year horizon. So we'll have to live with the market. But as I mentioned earlier, index is at one level. The rest of the market is not necessarily at the same higher level. And if you pick up right stocks at good prices and you have ability to hold on to them through the volatile ups and downs of the market, then you will make money.
Okay. Nilesh, Sanjay, gentlemen, thank you so much for taking the time out and speaking to us today on such an important day. Really appreciate your time. The two very important voices talking about their thoughts. Maybe there's some more upsides. For now, 153 odd points for the Nifty Bank, about 2 percentage points higher. We'll take a break, but come back and tell you all about what the seat situation is looking like at the current point of time. Stay tuned to Bloomberg Quint Live.